Okay, we'll move on to a new subject in FRM, which has a weightage of 30%. So almost you can expect 30 questions out of the total 100, where the focus is on all financial markets and products. Right. So the major thrust is still on derivatives. Of course, there is some kind of introduction to corporate bonds and various other instruments also, but there is a good amount of thrust on derivatives as a subject, and how do we use actually the derivatives in the risk management process. So the first chapter is primarily focused on introducing you to the world of derivatives. So see, today we typically see I can buy or sell securities, let's say on the spot, like in the equity market, I can buy some shares on the spot, right? A bond I can take on the spot. So that is typically called as a spot market. Whereas when I try to buy something or other in future, not today, but some kind of buying or selling something in future with a price agreed upon today is what we call as a derivative security. So most of the buyings or sellings happen at a future date. All the buying and selling happen on a future date. The entire deal is taken up, which includes the price which you will pay on that date, the quantity which you will buy and sell on that date, and even the quality of the product, whatever, whether it is an agricultural commodity or a financial security or whatever it is, the real buying and selling of that happens at a future date, but today we get into an agreement for that, which is what is the most common thing in a lot of activities right from the very early generations, like paying an advance and booking something. Right, the actual deal will happen sometime in future, but we are getting into a contract agreement that this transaction will happen at a future date. We get into a contract on agreement today itself. Such kind of a trading world where the actual trading happens in future, but the details of the trading, including the price, the quantity, quality, all that stuff, are decided today itself. So it's like we get into an agreement today, but the full transaction happens at a future date. The date also we will decide today itself, the date on which the trading for that can happen. So that is, and it is not an isolated security, though the trading of it happens on a derivatives market, but its value is always derived from the underlying asset. So it's like derivative is not an independent instrument. So it's like a derivative on a stock. A derivative can be taken on a commodity. A derivative can be taken on a bond. A derivative can be taken on a currency. So it is on some asset. It's not an asset in itself. It is deriving its value from some asset. So it's like the future trading of something. That something is the underlying. And derivative is more of future buying or agreement, which will include the future buying and selling of that particular underlying asset. Underlying today can be almost anything and everything. Right? It could include all your commodities, or it could include your the stocks or bonds or currencies or index, anything. Right? Anything you see that the price of it is going to change in future, either up or down, and you know something about its future movement. You can reasonably predict its future movement. then you would like to take an advantage of that analysis to actually buy or sell your derivatives, so that you can take the advantage when the price really goes up or down in future. So when you assume, let's say today the price of some commodity is here, you with your some knowledge of analysis, some level of analysis, you thought that after 1 month the price is going to be here. Then the simpler thing for you is you will get into a derivative contract. What that derivative contract says, okay, I'll buy this from you at this price on that day. The other party also may be willing to sell it to you at this price because today's price is this much. But after some time you are slightly increasing the price and saying I'll buy it from you at that price. But the reality is you are thinking that the price of it will go to here. Your analysis saying it will go up to here. So basically you are getting this much of benefit. Even if you buy it here, you sell it at this price in the market immediately, you are getting this as your profit. But of course, there is a chance that the price, though you have fixed up the price here, on that day the price can go here. If the price goes here, you are losing out this much. But if the price really goes as per your expectation, you can really make out, you can make a gain out of it. So that is how the derivatives market, looking at the way you are evaluating your future, you try to take the advantage of that information processing which you have done, and that is where you are trying to get into the derivatives market. So this derivatives wise, if you understand this basic funda, any derivatives are one and the same. There are 4 types of derivative instruments in the market, but all 4 are one and the same if this funda is clear. Rest all is a slight variation in the products. So out of these derivatives, so derivative as such is an agreement only. It's a contract where the actual deal will happen sometime at a future date. Nothing is happening today. Now, if this contract, so there are 2 places where this contract can be executed. One is over the counter. When I use over the counter, there is no central marketplace. No, there is no physical exchange. There will be a lot of dealers who will act as buyers and sellers. Like some of your forex transactions and all we see. Let's say ICICI Bank is a dealer. You go to an ICICI Bank branch, you will see the dollar buy rate, sell rate, all that stuff. It's not a centralized market. See, when I talk about a stock market, there are only few centralized markets, a BSE, NSE, where anyone has to buy and sell only on that market. Whereas for these kind of stuff, for let's say currency, it's a completely dealer driven market. You have to approach one dealer, ICICI Bank or HDFC or Western Union Money Transfer, some one of these guys. They are all different dealers. They have their own buy price, they have their own sell price for different currencies. Right? So such kind of markets are typically called over the counter. It's completely between 2 parties. The transactions which are happening OTC are typically between 2 parties itself. Probably these 2 parties can be intermediated by some middle mediator, but it's purely between 2 parties. But when we talk about an exchange traded market, you have a physical exchange kind of a building in place, like a BSE, NSE kind of stuff. So some kind of derivatives are traded on the exchange. Even today in India we see the options. There are a lot of options that are traded on the exchange. There are a lot of futures that are traded on the exchange. So wherever the securities are traded on the exchange, we call them as exchange traded, and lot of trades just happen between 2 parties. Let's say bank 1 and bank 2 get into a swap agreement. So it's a over the counter. There is no marketplace for this swap transaction. So those are all OTC kind of trades, right? or probably a farmer and a middleman can get into a forward contract. That he will buy, the middleman will get into an agreement saying he will buy the crop from the farmer, let's say after 2 months, at a particular price. So irrespective of whatever is the market price after 2 months, he will pay the fixed price and buy from him. So those are all typically your derivative contracts. Sometimes they happen just between two parties. They are all forward contracts, or they are OTC contracts. And if they are happening between on an exchange at a central location, we are calling them as exchange traded derivatives. So the names wise, there are 4 types of derivatives, as I said. One is forward contracts. One is a future contract. One is swap. And the other one is an option contract. So these are the 4 different types of derivative contracts in the market. And as it is mentioned here, forwards and swaps, they are completely OTC. You don't have any exchange trading on forwards and swaps, right? Futures are the only instrument where 100% of the trading happens only on exchange. In fact, the prime difference between forwards and futures is only the exchange versus over the counter. The contract is more or less one and same. Of course, there are a couple of small differences, but the prime difference between forwards and futures is just the exchange presence. Forward is more of OTC, whereas futures is more of the exchange trade. Swaps are completely over the counter, which means 2 parties. So when I say 2 parties, we can very well customize our contract. As per our agreement, as per our understanding, we will customize our contract. So highly customizable contracts, probably highly negotiable contracts. We can negotiate the price, we can negotiate the quantity, quality, everything, right? So because it is between 2 parties, that is highly customizable. But the highly customizability also creates a problem of high scope for default. Okay, both of us got into an agreement, right? I will buy something from you after 1 month. What if I don't buy? Right? Or the other side, what if you don't sell? The scope of default is much higher. Right? There is always a scope, because in these kind of cases, because though there is a formal agreement and everything in place, again, if it is between 2 parties, enforcing it through a court of law and getting the entire thing settled, it's again an extra cost. You have to actually look at those costs also. So between the forward contracts and swap contracts, especially where it is just between 2 parties, because see, there is no initial exchange of money between the two. It's only today we just write an agreement, nothing more than that. Not even a rupee flows from me to you or vice versa. We just like we have a verbal agreement, right? Instead of having verbal agreement, probably you will have it in a documented form. But it's just a understanding between both of us that I will buy something from you after 1 month, you will sell something to me after 1 month. Depending on how the price will be at that date, I may be willing to buy from you or I may back out. You may be willing to sell to me or you may back out. So the scope of default is very high in case of OTC contracts. Whereas in case of exchange, the exchange takes some steps, some mechanisms to make sure that the scope of default is getting reduced. They have introduced a concept of margin. So this concept of margin actually avoids the scope for default, right? So whereas that cannot be possible in the case of over the counter. But yeah, if both parties agree that we'll settle it we'll have some kind of margins and we'll do the settlement accordingly, without the presence of an exchange, we'll try to create the flavor of an exchange, probably they can very well do that. So that is the way they can try to reduce their counterparty defaulting risk in case of forwards and swaps also. So most of the options are probably 50% of the options are traded on the exchange, and another 50% of them are traded over the counter. The most general kind of options are traded only on the exchanges, but most specific, they are typically called as exotic options. That world of exotic options, they are typically traded over the counter. But the most plain vanilla kind of options, we'll see what each of them are. They are traded on the exchanges itself. Now, okay, simply to understand these four instruments, probably let me give the basics of all the four, then we'll read through these. Okay, when I use the word forward, it's that plain basic agreement. I'll buy something from you at a future date, or you will sell something to me at a future date. The price of it is decided today, right? And the quantity, quality, everything are decided today itself. Now, for a buyer, right, from a buyer's standpoint, if he feel, in reality, if the market price of that future date, right, let's take an example. Today, the price of some article is 30 rupees a kg, some commodity, right? Now, I want to get into a forward contract as a buyer. Though we are talking of A and B. A want to get into a forward contract with B. How much? What is the duration of the contract? Let's say 1 month is the duration of the contract. For buying 1000 kgs of this commodity after 1 month, right, at probably 30.5 per kg. Now, why will he buy at 30.5 per kg? Today he could have bought it at 30 itself, right? See, a lot of constraint, probably cash flow constraint could be there, or he may feel, let's say he is a trader. He wants that if he is buying it today at 30, probably there may be some storage cost, some inventory, a lot of stuff could be there. So he wants it, let's say, on time after 1 month, where he really uses it for the production purpose or whatever. He uses it for some purpose only after 1 month. So there is no point in having the quantity today. And at the same time, he wants to avoid, let's say, those storage costs, spoilage costs and all that. And he wants to buy it exactly after 1 month, which can be probably used directly into the production. So then he is getting into an agreement, but he doesn't know what would be the price on that date. It may go to 32, it may go to 28. Anything is possible. But he is somehow confident, if it goes to 28, probably he can buy it on that day after 1 month at 28 itself. Right? And he can be more profitable than buying it at 30 today. But if it goes to 32, then he has to buy it at 32 and then use it in the production. His production costs are going to be higher. So what he thinks is, okay, even if the price goes up, because I would be in a problem. And let's say if he has some level of doubt that the price is going to go up only, he feels, why not I get into a contract? If there is some seller who is willing to sell that good to me at 30.5, let's say after 1 month, I'll get into an agreement with him. Right? So we'll get into an agreement. We both, you are ready to sell it to me at 30.5. I am ready to buy it at 30.5. So both of us will get into an agreement. Such kind of agreement which we are getting in today is what is called as a forward contract, where I'll pay you the money, you deliver me the good. Right? That's a forward contract. And where is it beneficial? What is the benefit for the buyer? If the market price is really more than 30.5 after 1 month, then it's a benefit to the buyer. If the market price is really less than 30.5 on that date, it's a benefit to the seller, because he is still able to sell it at 30.5. Right? So the typical payoffs wise, if I see, if this is a graph of market price on expiry is after 1 month. 1 month is the contract duration, and let's say this is 30.5. This would typically be the buyer's profile. For a buyer, the benefit is there, the profit is there only if the market price crosses 30.5. Whereas for a seller, and if the market price is much below, let's say 30.5, let's say at 29. If the market price is at 29, but he is still buying it at 30.5 because he has got into a contract. So he is having a loss of 1.5 per every kg. And if he is talking of 1000 kgs, he will lose 1500. So that is where there is a chance for him to back out, to default, because there is a scope for a loss for him and he may want to break the contract. Right? So that's where we are saying the scope for default is higher. And let's say probably the price falls down, let's say to 25 only. Even more bigger loss, because he has to buy it still at 30.5. So 5.5 rupees loss on each kg, and that's where the loss is going to be pretty huge. Right? So this is what is the and for a seller, his graph would be more like this. Complete mirror reflection of the buyer. What is the profit to the buyer is the loss to the seller, and vice versa. Mirror reflection over the x-axis. Whatever is the profit to the buyer is the loss to the seller, and vice versa. So this is what is this kind of graphs we actually call as payoff profiles. When is the buyer profitable and when is the seller profitable? The payoff profiles of both the